So when you're Betfair trading, it's important to understand volatility. Why? Because that will influence what sort of strategy you use in the market. Because if you have high volatility or low volatility, you should be amending the strategy that you're using. But also it should inform you how confident you are that you know what's going to go on with the market and the way that the market should behave. So this video builds on some of the other videos that I've done and tells you exactly how to understand what the volatility will be in a market. And if you want to learn that, then just watch the rest of this video. If you're interested in learning more about Betangel and what it can do, then visit our website, but also visit the Academy where you can get more detailed, structured content. You can also visit our forum where you can speak to like-minded people and download additional content. And of course, you can visit our website to download a free trial of the cutting-edge software that will completely transform your betting and trading. So first of all, let's define volatility. What is it? Well, it's how much the price moves over the course of a market or the time that you're in the market. The further out that you join a market, the wider that traded range will be, the more volatile the market will be. And if we're trading 1 second before the start of a race, then there's going to be no time for the market to move at all, so the volatility will be low. And when we look at that, that defines sort of what strategy that we're going to choose. Because if you have a market that's moving in a very large range, then you really sort of want to look at it as though, you know, if you get into the market at the worst possible position, that's how far it could go against you. Now, I know that that's a bit of a negative way of looking at it, but it's true. You have to think in those terms in order to balance out the positives and negatives with trading. So a large traded range means that you could lose a very large amount, but it also means that you could profit a large amount. So when you see a market that's very volatile, it's going to have a wide traded range, you can't really go for a simple scalp or something like that, a one tick move or a small move, because of course the potential on the other side is for when the trade goes wrong to be quite large. So basically the wider the volatility within the market, the more profit you have to go for to counteract the times when a trade goes wrong. And unfortunately, trades do go wrong. So it's important to balance out those two things. So wide traded range means you really need to go for a bigger profit to counteract the times when it doesn't work. However, when we get a small traded range, then that actually works quite well for us because we're saying the market won't move too far away from us, even if we completely mess up the trade. So we can go for slightly smaller gains. We can go into the market, do a trade, do another one, and keep doing all of those trades because we're not too worried that the market will go against us. So of course, the big question here is which market is likely to produce either of those two states. So let me define for you where you are likely to find these types of races. And, you know, when we're talking about this, we're sort of saying what race is going to produce a market that has a very, very narrow, low traded range, and which market is going to produce an absolutely ginormous one. Because if you start at the extremes of the market, then you can gradually get used to those sort of extremes, and then you can become a bit more adventurous and try to trade things that sort of sit somewhere in between the two. As you develop your skill and knowledge as a trader, you'll be able to trade those markets effectively, and then you'll be able to trade markets that quite don't fit those characteristics. And one of the things that I do every day is when I see races coming up, I will make a judgment on how I expect the race to trade. And one of the things I'm going to do in this video is tell you how a race is going to trade tomorrow, because it is possible to predict these sort of things. But fundamentally speaking, when we get a very competitive handicap, that tends to produce markets that tend to be range bound. And when we look at that, what we're saying is that nobody is really sure who the winner in this race is going to be. And therefore the market tends to allocate its money. The money arrives in the market across all of those runners. So some people back the second favourite, some back the third, some people lay the second favourite, some people back the favourite, and it sort of ends up in a wishy-washy, mishmashy, wibbly-wobbly sort of, you know, market. Nobody's really sure about what's going on, and you may get the odd move within the market, but generally a competitive handicap produces those narrow traded ranges. And if we look at the other end of the scale, if we get a novice or a maiden with unraced horses, and we've got a shorter priced favourite, those tend to be the markets that produce the wildest swings that you will see. So if a horse has no form line, nobody really knows what's going to go on with that market. So people tend to be betting using their emotion or opinion. And once that sets in place, because the horse has no form, everybody looks at the market, they see it beginning to move in either direction, and they will sort of say, oh, you know, the market really fancies this, or the market hates this, and off flies the price. It will head away at a rapid rate of knots. So you've got two complete extremes there in terms of the way that a market functions. very competitive handicap. It's a small traded range. And horses, a race where horses haven't raced before, probably a low quality race. There isn't much prize money and we've got a clear favourite within that race. Emotion and opinion takes over and you get a very large traded range. But there are other characteristics that sort of come into play here as well, which is what I want to show you next. So one of the key reasons for doing this video is I've been looking at the race cards tomorrow because it's the first day of the Goodwood Festival. And with the high quality racing, there are plenty of opportunities around. But it's also a great contrast in terms of what you expect to see in the markets. Because if we look at Goodwood, over the course of the day, there's about £700,000 worth of prize money, which is pretty big. And 300,000 of that is going to be on the feature race in the middle of the day. However, if we look at Lingfield, there's going to be less than 25 grand available in prize money at Lingfield across the entire card. And if we look at the lowest race of the smallest race of the day in terms of prize money, that comes at Yarmouth, which is just over 3 grand. So there's a 100-fold difference between the poorest quality race of the day and the highest. And that has a direct effect on the way that the market is likely to trade. So let's say, and I have said this in other videos, that we have a favourite priced at odds of 2. That tends to be where you find the most volatility within a market. That's where a lot of movement tends to take place. And then sort of either side of that, it starts to tail off a little bit in either direction. But the interesting thing is when we start looking at quality, that has an interesting impact on the market. Because if we look at a very low quality race, such as a Yarmouth or a Lingfield tomorrow, and we have a favourite going off at odds of 2, and perhaps it's a maiden race of some sort or a novice or something, you know, it's a lower quality race is what I'm trying to say. Then that traded range will be absolutely huge. Now, if we had the same race with better quality horses, which can be a sort of a proxy for that is the amount of prize money that you have available, and obviously Goodwood is where all the prize money is tomorrow, then it will still move around a little bit, but significantly less than you would get at a Yarmouth or a Lingfield. So as a consequence, you'd change your trading style to not be as adventurous as you would to get a massive trade at a Lingfield or a Yarmouth. You would still go for a larger trade, but you would sort of, temper your enthusiasm for seeing it rocketing off the top of the ladder. So there was a big difference between those different types of race codes and how much it impacts volatility. And if we look at a very high quality handicap, that tends to have the smallest range of the lot. So if you get a massive prize money and it's a group race somewhere, and all of the horses are priced at odds of 8 or 9 or something like that, that sort of market will exhibit very low volatility. And if you get a competitive handicap at a Lingfield or a Yarmouth, that will also work within a traded range, but that traded range will be bigger. So you have to account for those sort of factors when you're actively trading it. So the interesting thing that's happening tomorrow is we have the Goodwood Cup. And that's the feature race of the day. An interesting thing happens at Goodwood in that very often, we've got a fair bit of group racing tomorrow, but the quality starts off lower in the morning. It peaks at the big feature race, and then it sort of tails off from there. So over the course of the day, the way the markets trade change a little bit. But the feature race has Kyprios in it, and Kyprios is at a shorter price at this particular moment in time. Things could change between now and then, and there could be horses withdrawn and so on. But when I looked at the market this morning, I could see that it was heavy odds on. And an interesting thing happens when you get a heavy odds on favourite at a big meeting where there's lots of prize money, and that is that the volatility gets crushed completely. And there will be enormous amounts of money going on it. Why? Simply because there's been so much research. Everybody feels that they know what the horse is. It's got a long and strong form line. Everybody can price it reasonably well. And as a consequence, people will be sort of saying, well, I think it's going to do it, or maybe it won't do it. But they will be using large sums of money in that respect. And the same sort of goes for me as well. If I get a very high quality race meeting, I'm going to commit more money to the market, but also traditional punters will do the same as well. The reason I'm putting more money in the market is because I feel more certain about what the traded range will be and that it won't run away from me dramatically, whereas it could at Lingfield or Yarmouth, so I use smaller stakes. But when I trade Kyprios tomorrow, I'm expecting the market to move in small increments all of the time. Now, a couple of things could happen, such as the weather changes, or we have a jockey trainer gamble, or there's some theme that runs through the day that could influence that. But I strongly suspect that the smallest traded range that we'll see tomorrow will be in the Goodwood Cup. It will be a very narrow traded range. But if something interesting happens in the run up to that particular race, that may influence the market and expand it slightly. So you have to watch what's going on ahead of that. But typically that is exactly what I would expect. And also, if everybody's having a great day and a few favourites are winning and stuff like that, then you'll probably find that it will be backed in as well. That weight of money will start pushing down on it to go to an even shorter price. But yeah, when we look at all of those markets, they have very different characteristics. That will influence the traded range and the volatility, and that's primarily down to the quality of racing. So when you're actively trading, you're always looking at how volatile a market is going to be, because that will define the strategy that you deploy. If we look at some of the bigger race meetings, the volatility gets a bit crushed, and as a consequence, you're not going to get a large move out of that. And some people see that as a bit of a negative. However, the positive from all of that is that the price probably won't move against you too much, and therefore you can jump in and out of the market on a repeat basis and get a decent trade that way. However, when we look at the Yarmouth and Lingfields, we're not going to be going in those more volatile races for a one tick gain, because the problem that we will have is we may get that repeatedly over a long period of time, but when the market moves against us, it will move against us significantly. So there's more risk in the market. And if there's more risk, then you compensate for it by trying to make more profit to offset that risk. It's all about a balance of profits and losses over a period of time. And while you can't get it right every single time, as long as you put yourself in roughly the right position, then you should do okay. When we look at Goodwood, we're going to see the quality rise over the course of the day until we get that massive peak during the Goodwood Cup. And because we have Kyprios at a shorter price, we can sort of begin to determine how that is likely to play out. So when I actively trade that tomorrow, I will be upping my stakes, and so will everybody else. And so the volatility will get crushed. And there'll be a little bit of input from what's happened in the races just before that. But fundamentally speaking, we would expect it to trade in a narrow traded range and probably be backed, in all honesty. Some of that, like I said, depends upon what happens in those races beforehand. But you get a big crowd, loads of drink, and a very short priced favourite, and everybody sort of goes, I wonder what horse I should bet on here. I know, I'm going to stick £1,000 on this because it's bound to win. And that just filters through into the market. So yeah, as long as you adapt your trading style to what you expect to see, that will make you a significantly better trader and will also give you a much better chance of being able to get a profitable trade.